Today we have discussed about accounting ratio part 2. What is leverage ratio? Leverage ratio or solvency ratio. So first we have to know about the term solvency. Solvency means the ability of a firm to pay its outside liabilities. Outside liabilities includes long-term liabilities and short-term liabilities. So here solvency means the ability of a firm to meet all short-term and long-term obligation. Okay, am I right? Then long-term liabilities includes debentures, long-term loans, mortgage loans, etc. Then there are different ratios are used to measure the leverage or solvency of a firm. Mainly, there are two types of solvency ratios are the structural ratios and coverage ratios. In case of structural ratio, it shows the relationship between own capital and borrowed capital. And mainly these ratios are based on the balance sheet items. It is mainly calculated to know the ability of a firm to repay the principal amount when it is due. And coverage ratios are computed from the statement of profit and loss account, and it helps to ascertain the firm's capacity to pay interest and dividend regularly. Then what is structural ratio? Structural ratios mainly focuses on a firm's long-term solvency. It measures the extent of debt financing in a firm. It is also known as capital structure ratio. Mainly the important structural ratios are debt equity ratio, total asset to debt ratio, proprietary ratio and solvency ratio. Next, we have to discuss about debt equity ratio. The name itself suggests that it's a relationship between debt and equity. So, what is debt? Debt is external equity and equity means internal equity. So, the ratio is also known as external internal equity ratio or security ratio. Mainly, there are two types of debt equity ratio. Long-term debt equity ratio, it shows the relationship between long-term debt and equity. Here, long-term debt means the fund invested by the outsiders fund. Adile debentures, mortgages, all long-term loans are included. And the other name of long-term debt equity ratio is external equity or borrowed funds. The second portion of long-term debt equity ratio is equity. What is equity? Equity includes share capital, preference share capital, reserves and surplus. So, it is also known as shareholders fund or internal equity. When we calculated the amount of equity, we should deduct all the accumulated losses and fictitious assets. That means preliminary expenses. Then we got the amount of net worth. Then long-term debt is equal to debentures, mortgages and all long-term loans. Okay. Then equity or shareholders fund is equal to equity capital plus preference share capital, then all reserves and surplus. Total debt equity ratio is equal to total debt divided by equity. Total debt is equal to long-term debt plus short-term debt or current liabilities. The standard of total debt equity ratio is 1:1. Total debt to 1, equity also represent 1. The interpretation of total debt equity ratio is high ratio indicates safety to creditors and low ratio indicates greater risk to creditors. Next, proprietary ratio. It shows the relationship between shareholders fund and total assets. That means how much funds have been contributed by the shareholders in the total assets of the firm. The other name of proprietary ratio is equity ratio or net worth ratio. The formula of proprietary ratio is shareholders fund divided by total assets. The results of this ratio can be expressed in proportion or percentage form. Then how will be calculated the amount of shareholders fund? Share capital. Share capital includes both equity capital and preference capital and all reserves and surplus and all undistributed profits, and from this total we should deduct the amount of all accumulated losses. And the standard of proprietary ratio is 0.5:1. How it is interpreted? High ratio indicates safety to creditors and low ratio indicates greater risk to creditors. Then next we have to talk about ratio of total assets to total debt. The other name of this ratio is solvency ratio. It shows relationship between total assets and total liabilities of a business. Okay. It measures solvency of the business. Solvency ratio is equal to total assets divided by total debt. As we already discussed that total debt is equal to all long-term debt plus short-term debt. Then fixed assets to net worth or fixed assets to proprietors fund ratio. It shows relationship between fixed assets and proprietors fund. So fixed assets to net worth ratio is equal to fixed assets divided by proprietors fund. It shows the extent to which shareholders funds are invested in fixed assets. Okay. Then fixed asset ratio. It shows the relationship between fixed assets and long-term funds. Long-term funds is equal to capital employed. Fixed assets plus investments plus current assets minus current liabilities. Or in the share capital plus reserves and surplus plus long-term liabilities. Then you got capital employed or long-term funds. Then the higher ratio indicates the financial position is not good. The standard level of fixed asset ratio is equal to 0.67:1 or 66 2/3. The fixed ratio is more than 1:1. How we interpret? It indicates that a part of fixed assets has been financed out of short-term funds. Clear? Next, we go through capital gearing ratio. What is capital gearing ratio or leverage? Okay, capital gearing or leverage. It shows the proportion between fixed income bearing funds and equity shareholders fund. What is fixed income bearing funds? Debentures, other long-term loans and preference shares are collectively known as fixed income bearing funds. Equity shareholders fund is equal to equity capital plus all reserves and surplus. So the formula for capital gearing ratio is equal to fixed income bearing funds divided by equity shareholders fund. Right? Then what it shows? It shows the effect of use of fixed interest or dividend bearing funds on the profit available to equity shareholders. Higher ratio indicates the risk of fixed commitments and more burden generating profit to equity shareholders. But on the same way, it may result into benefit to equity shareholders by the effect of trading on equity. Okay. Next, we have to talk about coverage ratio. What is coverage ratio? Mainly, coverage ratios are used to test the firm's debt servicing capacity. Debt servicing capacity means the ability of the firm to make periodic payments of interest and preference dividend. Mainly, the important coverage ratios are first interest coverage ratio. It shows the capacity of a firm to pay interest on loan and debentures regularly. It shows the relationship between operating profit and interest charges. So, interest coverage ratio is equal to profit before interest and tax divided by interest. The standard of interest coverage ratio is equal to 6 to 7 times. How it is interpreted? Higher the ratio, stronger is the ability of a company to pay interest. Low ratio indicates excessive use of debt and inability to offer assumed payment of interest to creditor. A too high ratio indicates unused debt capacity. Next, dividend coverage ratio. It shows the ability of a company to pay dividend on preference shares carrying a fixed rate of dividend. So, the formula is earnings after tax. The short form is EAT. Earnings after tax divided by preference dividend. The standard of this ratio is 2 times. Higher the ratio, it is better from the point of view of preference shareholders. Okay. Next, total or overall coverage ratio or fixed charges coverage ratios. It shows the ability of a company to service all fixed obligation out of its earnings. Okay. That means the fixed obligations are include interest on loans, debentures, preference dividend, lease payment and loan repayments. So, this ratio shows or indicates the overall ability of a company to service outside liabilities. The formula of this ratio is EBIT. What is EBIT? Earnings before interest and tax divided by total fixed charges. Then we have to discuss some practical problems. Here are questions related to equity share capital. There are so many items are here. Equity share capital, preference share capital, general reserve, profit and loss account, 7% debentures, sundry creditors, current assets, fixed assets and investments, and the calculate debt equity ratio, proprietary ratio, solvency ratio. So, നിങ്ങൾ എന്ത് ചെയ്യണം നന്നായിട്ട് ഇക്വേഷൻസ് ഒക്കെ പഠിച്ചു വയ്ക്കുക. ഡെപ്റ്റ് ഇക്വിറ്റി റേഷ്യോ ഈസ് ഈക്വൽ ടു ലോങ് ടേം ഡെപ്റ്റ് ഡിവൈഡഡ് ബൈ ഷെയർ ഹോൾഡേഴ്സ് ഫണ്ട്. So, here the long term debt include only 7% debentures. Only the item 7% debentures. Then shareholders fund or proprietors fund is equal to equity share capital plus preference share capital plus general reserve plus profit and loss account. So, the amount is 4,20,000. So, debt equity ratio divided is equal to 2 lakhs divided by 4,20,000. The result is 0.48 is to 1. The interpretation of this result is it is below the standard. Our standard is 1 is to 1. Okay. So, the company is not financially sound. Then, next we have calculate the amount of proprietary ratio. What is the formula? Shareholders fund divided the total asset. Already we find the amount of shareholders fund, that is 4,20,000. Okay. Then total assets Here total assets is equal to current assets plus fixed assets plus investments. Okay, current assets plus fixed assets plus investments. So the total is 7 lakhs. So proprietary ratio is equal to 4,20,000 divided by 7 lakhs is equal to 0.6:1, that is 60%. The interpretation of this ratio is shareholders' contribution is 60% of total resource used. Okay. Next, solvency ratio or total assets to debt ratio. What is the formula? Total assets divided by total debt. Here total assets is equal to 7 lakhs, that we already found out. Then total debt or total liability is equal to 7% debentures plus sundry creditors is equal to 2 lakhs plus 80,000 is equal to 2 lakhs 80,000. So the solvency ratio is equal to 7 lakhs divided by 2 lakhs 80,000 is equal to 2.5:1. How it is interpreted? The company is solvent because assets are sufficient more than liabilities. So the company is financially sound. The next, the other calculate fixed asset ratio and capital gearing ratio. The other problem. And here so many items are given: equity share capital, preference share capital, long-term loans, 6% debentures, reserves and surplus, current liabilities, fixed assets and current assets. First we have to find out the amount of fixed assets ratio. What is the formula of fixed asset ratio? Fixed assets divided by long-term funds. Fixed assets is equal to 7,50,000 direct ആയിട്ട് നമുക്ക് തന്നിട്ടുണ്ട്. Then we want to find out the amount of total long-term funds. Long-term funds or capital employed is equal to equity share capital plus preference share capital plus long-term loans plus reserves and surplus plus 6% debentures. The total 6 lakhs. Right? So fixed asset ratio is equal to 7,50,000 divided by 6 lakhs. The result 1.25:1, that means 125%. The standard of this ratio is 1:1. So the result is more than 1:1. That means it indicates that a part of fixed assets has been financed out of short-term funds. Okay. Then next we want to calculate the amount of capital gearing ratio. Fixed income bearing funds divided by equity shareholders fund. Fixed income bearing funds is equal to what is preference share capital plus long-term loans plus 6% debentures. 1 lakh plus 1 lakh plus 1,25,000 is equal to 3,25,000. Equity shareholders fund is equal to equity share capital and reserves and surplus. The amount total is 2,75,000. So capital gearing ratio is equal to 3,25,000 divided by 2,75,000 is equal to 1.18:1. So the high geared. Next, we want to calculate interest coverage ratio, some other problem. The operating profit of A Limited after charging interest on debentures and tax is 1,60,000. Amount of interest is 40,000 and provision for taxation is 80,000. So first we have to write the formula for interest coverage ratio, that is equal to profit before interest and tax divided by interest. Here we get we given the amount of profit after tax, but we need in the formula we need profit before tax. Am I right? So for calculating this profit after interest and tax എന്നുള്ള ഒരു എമൗണ്ട് ഉണ്ട് 1,60,000. അത് എന്ന് പറഞ്ഞാൽ ഇൻട്രസ്റ്റ് ടാക്സ് ഡിഡക്റ്റ് ചെയ്തതാണ്. സോ നമ്മൾ എന്ത് ചെയ്യുക, തിരിച്ച് അങ്ങോട്ട് തന്നെ ആഡ് ചെയ്യുക ഇൻട്രസ്റ്റും ടാക്സും. 40,000 and 80,000. Then we get the profit before interest and tax. 2,80,000. So interest coverage ratio is equal to 2,80,000 divided by 40,000. I think one more zero is here only 40,000 there. 2,80,000 divided by 40,000. ഒരു സീറോ അതിൽ കൂടുതലാണ്, അതൊന്ന് ഒഴിവാക്കണം. is equal to 7 times. So the interpretation is the company has the capacity to pay the interest. That is, our standard is 6 times or 7 times. The answer ഇത് തന്നെ വന്നിട്ടുണ്ട്, 7 times വന്നിട്ടുണ്ട്. Okay.